Onward to the topic of the day, philanthropy and impact investing. Now, if you want to talk philanthropy, you got to go back in time 120 years to maybe the father of philanthropy, Andrew Carnegie. Here's a man, he came to the United States as a teenager penniless, and his goal was to be rich, and he succeeded at that, right? He's listed as the number 3 or number 4 richest man of all time. He's the second or third richest American of all time, and he built that empire. It was called Carnegie Steel, right? It was a steel company and a coal company and an iron ore company, and he owned some railroads. It was a big thing. It was a trust back then. It was one of the trusts of the Gilded Age. And then in 1901, yet another one of these Gilded Age legends, J.P. Morgan, decided to buy Carnegie Steel and merge it with some other companies and create U.S. Steel, which still exists to this day. And so Mr. Carnegie, Andrew, he sold his company to J.P. Morgan for then $492 million. That's equivalent to like $15 billion today. And then it got even bigger, and Carnegie made even more money. And he's listed at like $300 or $400 billion of equivalent net worth back in the early 1900s. So here he was old but not dead, and he decided that he would give it all away, which was not a normal thing to do. His friends and his peers thought that was crazy. That's not what rich people did back then in 1900. So what did he do? Well, he couldn't start a foundation because foundations didn't exist yet. So he started the Carnegie Corporation of New York, and its mission was to give away money. One of its biggest missions was to create libraries. And the deal was, it was a little bit for-profit. The deal was, if you were a community and you promised to fill up a library with books, the Carnegie Corporation would build you a library. And it built thousands of libraries. And they're still around, and I believe that deal still exists. I think they're still building libraries. But that wasn't enough. Mr. Carnegie, he built all sorts of nonprofits, what are now nonprofits. Back then, everything was tax-free. There was no income tax. He built all sorts of organizations, some dedicated toward peace, some toward science. He started Carnegie Tech, which is now Carnegie Mellon, which is my alma mater. Like, he did a lot of good in the world with this money. And crazy enough, these orgs still exist. They're still giving away his money. All right, so if you step back and think about it, he's an inventor. Andrew Carnegie invented the idea of get rich, spend all your time getting rich when you're young, and then give it all away before you die, or soon after you die, or in this case, 100 years after you die. Right? That's an invention. That's an idea that didn't exist over 100 years ago. But there's a consequence. There's an unintended consequence of this idea, which is that other people followed him. John D. Rockefeller followed him, the Rockefeller Foundation, also in New York, also still giving away Rockefeller money. And if you look at the top foundations, if you look at the big foundations, every single one of them came from either an entrepreneur or an incredibly lucky investor, right? But they all came from a person making a lot of money and then turning it into a foundation. And the consequence of that is that we now look to the foundations to solve the big problems of the world. We look to them to solve the problem of global poverty and hunger and global health and pretty much everything else, right? If you look at the UN Sustainable Development Goals, that's kind of the purview of the nonprofit world and the governments, right? We don't look to the for-profits to solve those problems, but we should. And I'll explain why we should in a little bit, but first let's go back to this space here where I put investing in one corner and I put philanthropy in the other corner, and I did that on purpose. I did that because it's really a continuum, right? They're actually related. They're actually the same thing with different goals. So here are the goals. If we go on the vertical axis, we have the goal of financial return. So on this landscape, the further up you are, the more return you want. So if you just think of Wall Street and typical wealth advisors, they're going to advise you to make an investment that has the biggest return possible for the risk you're taking, right? There's no risk on this map here. And if you're looking at philanthropy and you're talking to philanthropists, well, they're going to make grants. And a grant is an investment where you get no money back. It's 100% loss, right? In the terminology of investing, right? It is a 100% loss investment, or it's a 0x return. The reason we do that, there's a purpose for that. It's not madness. We do that because on the horizontal axis is impact. And so philanthropy exists to maximize impact. We want to have the most impact possible per dollar we're using without getting any return. And on the investing side, again, back to Wall Street, most of the companies, if you look at the public companies, Most of them have no impact or have at least no positive impact. And yet lots of people invest in those companies and buy their debt and so forth. So on the one end, we don't care about impact. On the other end, we want to maximize it. So it's really similar to that vertical axis, but measuring impact instead of financial return. So that gives us a landscape. And what's interesting is that all the space in between is impact investing. And this is what makes impact investing so hard to define. It's not a thing. It's a landscape except for three corners, right? It's not full on, make as much money as possible, I don't care about the impact. That's not impact investing. And it's not philanthropy, make as much impact as possible and lose all my money. That's not impact investing. And it's not this bottom left corner either. And that part's left white on purpose. It's left white because that's the corner of I had no impact and I lost my money. So that's the worst of both worlds. Nobody chooses that corner on purpose. A lot of our investments end up in that corner in hindsight, but we don't aim for that corner. On the bottom right corner, well, that's the world what we often call, at least the for-profiteers would call, concessionary investing. So I want to have as much impact as possible. I want to move over to the right as much as possible. That's good. But I at least want my money back. That would be a concessionary investment. I give them money like a recoverable grant. I give you $50,000. And if something good happens, give it back. Maybe give it back with 2% interest. Or maybe even I'm going to give you a grant to get you started. And then once you're started, I'm going to lend you money at, let's say, 2%. And when you add those together, that might be a negative 50% investment, but it's usually not talked about like that. A friend of mine, Stephanie Gripney, she's going to teach one of these lessons. She's going to teach that because she, in fact, teaches foundations and family offices how to be extremely happy making a negative 20% or negative 50% investment as opposed to losing everything. All right, I have a friend who runs Beneficial Returns. It's a great example of a concessionary fund. It's a fund. It's a for-profit fund. They make loans as growth capital in emerging markets, and it returns 2% per year to its investing base. Right? That's its guarantee. It's never going to make more. It hopefully never make less. It hasn't made less yet. But getting 2% returns is not a market rate return for that kind of risk. As opposed to the top right corner, this is the cake and eat it too corner. This is the corner that I live in. Right? This is where Fledge lives in. What we're looking for are great, impactful companies that return whatever the risk-reward return should be. So we want to make money, but we want to have impact with every investment. And given a choice, we're actually going to choose the one that has a bigger impact, not the one that's going to make more money. Right? That's the kind of investors we are versus my friends at Capria. Capria is a global network of impact funds. And they would usually make the opposite trade-off. They're going to pick the company that makes the most money as long as it has enough impact to belong in this corner. Right? It's got to be a great impact company, but they're going to choose the one that's going to make them the most money. They're more VC-like than Fledge is. And again, it's a landscape. It's fine. You can be anywhere on this landscape you like, including the top left corner. There's nothing wrong with the top left corner. Those are investors that say, impact's great. I'm going to have impact with every investment I make. But I'm not going to trade off anything because that company's having impact. I want the same returns that you make in Wall Street, but I want them with impact. And so two great examples of that is City Light Capital out of New York City. And they've taken a bunch of companies public, a bunch of impact companies. They've taken them all the way through IPO. Amazing job. Another example of that is IX. IX was started by Warren Buffett's grandson, Howard Warren Buffett. It's aiming to be the Berkshire Hathaway of impact. They're value investors in impact. It's great to watch. And they're totally in this corner here, right? Again, given a choice between two investments, both have impact. As long as both have impact, they're going to take the one that has the bigger return. All right, so that's a little bit of an idea of what impact investing is. And now let's go look at the difference in scale between the philanthropic world, the nonprofit world, and the for-profit world.